Profits for Singapore's big three banks continue to soar, with the second quarter seeing better than expected earnings. They're declaring higher payouts of about 15 cents per share on average. Analysts say prospects remain bright for the banking sector despite the resurgence of COVID-19 in some parts of the world. Chloe Chu reports.
Singapore's three main local banks, DBS Group Holdings, UOB and OCBC Bank, saw profits boosted, mainly by lower provisions for bad loans. But one bank stood out from the rest.
DBS was a clear outperformer because they had lower credit costs from provision write-back. UOB also surprised us on their generous interim dividend of 60 cents, although profit was in line, and OCBC profit was in line with our expectation.
The higher payouts from the big three come after regulators finally lifted a cap on dividends. DBS booked a profit of $1.7 billion for the second quarter. UOB's rose 43% to $1 billion. And OCBC continued its rebound with a 59% increase in net profit to $1.16 billion. Analysts say healthier loans help to shrink non-performing loans. And this is likely to continue amidst an improving COVID-19 situation and economic outlook.
There are some pockets of uncertainties in the region. You know that we do have lockdowns in the regional countries, but rapid pickup in vaccination rates should actually help to restore some hope. So loans growth, I think, should be steady.
Banks have put aside a huge amount of money for a rainy day. And these are quite substantial. So DBS has 4 billion, UOB has 3 billion, OCBC has 2 billion. Taking into account all of these factors, the huge amount of provisioning and the better economic environment, they are seeing a much better loan book outcome.
But even though net interest margins are promising for the banks, analysts have their eye on fee income.
Fee income on areas like credit cards have improved, but not to the extent that they were pre-COVID. So further improvement would depend upon whether travel is possible. We'd expect things to be a little bit more flattish for the rest of the year.
He also adds that banks are likely to use their excess capital to fund mergers and acquisitions, but cautiously.